Everyone is a genius in the bull market, but what happens when the market turns against us? When stocks start dropping, people panic, portfolios shrink, and hard-earned money disappears. The real question is, how do we protect our money when the markets go south? In this video, we're going over 4 powerful strategies to protect your stock portfolio during a market downturn. Whether you're a long-term investor or an active trader, these techniques will not only reduce your losses, but also position you for future gains when the market rebounds. Let's dive in. Market corrections happen all the time, but here's the tricky part. No one knows when they'll happen or how long they'll last. So people panic sell, and that locks in their losses, but doing nothing can be risky as well. That's why having a strategy is crucial. Let's go over 4 ways to protect your portfolio when markets take a hit. First up, we have dollar cost averaging, DCA. Instead of investing all your money at once, you spread out your investments over time. This reduces the risk of buying at the peak and lowers your average cost per share. Imagine you had 1 share of Tesla at $500. Now you want a dollar cost average, so you end up buying Tesla at $300. So now you have 2 shares, one bought at $500 and the other bought at $300. So now your new cost average is $400. So in order to break even, Tesla needs to only go back up from $300 to $400 instead of $300 to $500. When prices drop, you end up buying more shares. This helps smooth out the volatility and keeps you in the game without having emotional investing mistakes. Now the second strategy is inverse ETFs, such as VXX or SQQQ. These are designed to go up when the market goes down, making them a useful hedge in a correction. For instance, SQQQ moves opposite to the Nasdaq. So if tech stocks crash, SQQQ rises. Similarly, VXX benefits from the market volatility spikes. These aren't long-term holds, but they can help cushion your portfolio in the short term if you have a feeling of uncertainty. Next up, we have dividend ETFs, like SCHD, which focuses on high-quality dividend-paying stocks. These ETFs tend to be more stable and provide income during downturns. If your portfolio drops 10%, but you're earning a 3 to 4% dividend yield, that helps offset losses. Plus, reinvesting those dividends at lower prices means you'll have more access to shares when the market recovers. And finally, let's talk about put options. Put options act like insurance for your investments. A put option lets you sell a stock at a set price, protecting your portfolio from a crash. Say you own 100 shares of Apple and you buy a put option at a $150 strike price. If Apple somehow drops below to $120 per share for Apple, your put option increases in value, offsetting your losses. But keep in mind that options does require learning and do have expiration dates, so they're not for everyone. But when used wisely, they provide a strong safety net. So let's recap the 4 ways to protect your portfolio during a market correction. The first one, dollar cost averaging, which helps smooth out the volatility. The second one, inverse ETFs that hedge against downturns. And the third, dividend ETFs to help generate income and doesn't drop as much during downturns. And lastly, we have put options, which helps ensure your investments. The key is to stay calm, think long term, and use the right tools at the right time, because market corrections are definitely something that is going to be common. Market corrections can feel scary, but they're actually opportunities in disguise. The investors who succeed are the ones who stay disciplined and prepared. By using these strategies, you can not only protect your money, but come out ahead during market rebounds. Now I want to hear from you. What are your favorite ways to protect your portfolio during a downturn? Do you even have a strategy in mind? Comment down below, and if you found the video helpful, hit that like button and make sure to subscribe for future videos.